Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the US dollar index had a pretty strong decline on the Friday session. Friday, huge move to the downside. People just got ripped apart in the morning session and even in the afternoon. Moving on, let's talk about what the reason was for that. First of all, the Italian 10-year bond yields have declined all the way down to that 6% area. And again, the main reason why bond yields are so important is because it's a measure of confidence. It's a vote of confidence in whether or not these governments are able to pay off their money or if they're not able to pay off their money. It's also very important because if the yields were to drop, that means that people are willing to pay less, or not really pay less, but earn less in interest and pay more for per coupon note. Now, if the interest yields were to suddenly go up, that would mean that they would demand more for they would pay less for per coupon note, and they would demand a higher interest rate in return for taking on that risk. Right now, the risk of people interpret the risk of buying Italian bond yields to be less than what it is currently. Basically, people, I think this whole entire idea that these Italian bond yields are so, they're attractive, but they're not really attractive. I mean, they're pulling back temporarily, and I think the yields will eventually go back higher. The main reason is because Italy has not really addressed its issue. Passing legislation and managing risk by proactively cutting spending are two very different things. Because one is just a piece of paper document stating that this is what you have to do, and another is actually applying what you have to do. And until they actually apply what they're going to say they're going to do, there's no logical basis and no logical reasoning for why the yields should be dropping. Unless if people are buying bonds temporarily, or if there is some foreign central bank intervention, or some form of monetary policy that is having an effect on these bond yields. I want to point out the main point though. These yields are bottoming out at around 6%. Okay? Notice this double bottoming pattern right here, 6%. It would not be surprising in the near-term future to see the bond yields rally up again. And if the yields were to rally up again, that would mean people are demanding more interest per unit of risk, basically. And if people are anticipating more return for the amount of risk they're taking on, the value of those bonds will continue to decline, and that would be a vote of no confidence amongst bond investors in Europe. If that were to happen, chances are the euro-US dollar will eventually pull back. Okay? Now, we didn't have as good of a rally from October all the way to November in the euro-US dollar, but we did have a pretty sizable one. I mean, we came off from around 1.26 and we gained about 8 points. So it's not bad, you know. I mean, not 8 points, but 6 points, but that's still, you know, that's alright. Again, it wasn't as much as the 10 points that could have happened, but we're not certain yet. We want to watch those Italian bond yields. The other picture that we could see coming out of the bond yield, though, is perhaps if this bond yield were to break below that 6% area, chances are, you know, the stock market would have an amazing rally. Going into the stock market chart, though, let's look at it very closely. We have two conflicting areas. One of them is the multi-year pennant, the top end of it. Okay? We've been above this line for the past 1, 2, 3, 4, 5, 6, 7 consecutive sessions. Okay? And that's pretty good, but it's not real. It's a weak confirmation. It's a weekly confirmation. We've only been above that level for a week. So it's weak, and it's weak, you know, I mean, I guess you could call it that. And the other level is the double topping, now the triple topping pattern. It can't break above that triple topping pattern, and it's barely sustaining above this multi-year pennant. Now, if it's able to hold on to that multi-year pennant, at the very least, this market could explode even higher, even above those double topping patterns, but that would only happen if the Italian bond yields were to break below that 6%, because that would mean a vote of confidence, and people want to get back into the bonds because they feel that somehow they're missing out on some form of bond appreciation. Now, if that didn't happen, okay, and people just shun the bonds and they continue to sell them and go off the rocker and go back to the Japanese bond yield trade, then you're not going to see any of this happening. Chances are the stock market pulls back. And I think for the most part, market participants have a belief, at least according to the options market, people believe that stocks are going to have a pullback. Okay, it's being priced into the options contracts, and let me explain why. You look at the call options, right? The 131 calls, and they have an implied volatility of around 14.11. Look at the 131 puts. They have an implied volatility of around 18.22. So it's about 4% spread between the two, but the 4% goes to the put option side. Notice though, on the call option side, there's much more open interest than there are in the put option side. Because there is much more open interest on the call option side than there is the put option side, you would have to think, the rules go like this basically. Implied volatility is always going to be higher on the put option side. However, because there's much more open interest on the call option side than there is on the put option side, and you're nearing the highs of a marketplace, because we're trading into the highs at the very top of it. Chances are, according to these options valuations and the open interest, and of course the implied volatility is actually kind of cheap right now. And not only that, there's very little open interest in comparison to the open interest on the call option side. So again, people are overly exuberantly bullish and not exuberantly bullish enough to there's not enough purchasing of put options quite yet, at least over the short term. However, just because there aren't more puts, there aren't more bears than there are bulls, that doesn't change the fact that people are still willing to pay much more money for a put option than they are willing to pay for a call option. So just because the crowd is smaller on one side of the trade than the other doesn't mean that that crowd is necessarily dumb, because according to what they're paying for something, they're willing to pay much more for per unit of risk, basically. Moving on to the March 2012s, we even see a bigger spread. The 132 calls, 131 puts. We'll do a butterfly, okay? Implied volatility is 13.96 on the call option side, and the implied volatility is a whopping 21 on the put option side. And notice though, further on in the future, there's much more open interest for put options than there are call options. So already the options markets are pricing in even further volatility in the future. And remember, additional volatility means that the value, people are anticipating stocks to pull back, because the only time you have volatility, according to the math, is when stocks are pulling back. Therefore, people are anticipating the higher likelihood of a pullback than of continued upside. Okay? So that's what the options market are saying, and this is what the technical analysis is saying about it. We are near the upper edges of a marketplace, and chances are it wouldn't be surprising for us to pull back from resistance. This is what the bond market is saying. Bond market is saying that we're having trouble breaking below that 6% area, and chances are there won't be enough demand to satiate the amount of sellers, and chances are people are going to liquidate whatever profit they've made over the short term, buying the bond yields and earn the coupon, basically the coupon value of it, rather than earning any additional interest off of it. So therefore, they're going to sell the bonds for a profit, and because they're going to lock in their profits, chances are the yields will jump back even higher. As far as the US dollar index, the reaction from that is going to be very positive, because the US dollar will inevitably rally, because the Euro-US dollar will pull back if in the event the Italian government bond yields were to somehow suddenly rally, which they most likely will. Okay, so that's the whole technical analysis aspect, along with options pricing included. Gold market, however, is continuing to go higher outside of this area right here. Gold is a special case scenario, at least for the day's trading, because gold went up in a time when the dollar index was pulling back and the Dow Jones Industrial Average was pulling back. That typically doesn't happen because, again, markets are very, these two like to trade very inverse to each other. It's an inverse pair. It's a hedge, basically, against one another. However, the Euro-US dollar also had a pretty strong day, and that's because of the Italian bond yields. In the case of the gold market, though, the way you could interpret it is, well, maybe if I was a stock trader and I was looking for something hot on the day, and I was looking for something that was going to appreciate, The only thing that would make logical sense is gold and silver, because gold and silver is paired to the US dollar. If the US dollar were to fall, proportionally gold and silver should go up, and because there's a higher beta for gold and silver will move proportionately maybe 2 or 3 times faster than the rate of decline of the US dollar index. I also want to point out the fact that gold is also a safety play, because whenever stocks are declining, chances are people like to reallocate into gold. So that's another factor. Stocks are pulling back, gold had the dollar to back it, and not only that, you know, I mean the value of the dollar was pulling back, and not only that, you know, it's a safety play. People like to buy it when things aren't working out too well. Silver, on the other hand, isn't as much of a safety play because it's the very definition of volatility. So gold had a better day per unit of risk than silver, because the amount of money you would earn and the amount of money you would risk on gold would be less than what you could honestly earn off of silver for the amount of risk you're taking on. So again, that's just why gold had such a great day in comparison to silver. Typically, you want to see gold go up by around 1.28% and see silver go up by around 1.12%. Because typically silver likes to go up around 3-4% whenever gold goes up around 1% in a day session. However, because of the environment and the risk allocation methods that a lot of people use, I mean, between silver and gold, and you know, between the two, and your mindset is you want to trigger a safety play, chances are gold would be much better than silver. And if the stock market had a great day because the US dollar index happened to decline, chances are silver would have had a wonderful day. Much better than gold. So I just wanted to explain to you why that happened. Now, would I buy silver at this point? Perhaps not. I mean, this is where I was planning to sell silver, in fact, not where I would buy it. So, again, if you want to know my opinion on it, I would not buy silver, and I would, you know, perhaps gold is okay if you're a longer-term trader. Volatility index may be bottoming out in the short term, and we're getting close to where we were back in August, but we want to wait and see, and we don't want to jump the gun. Moving on, YOKU.com is double topping, and chances are it could pull back from this point, and that's because the broader market sentiment is weak. Take care, folks, and I'll see you soon.